Welcome to today's webinar. We're so glad that you're able to join us. We know that we have an informative discussion ahead for you guys. We've heard from you and we've listened, and so we've brought together some great experts today to talk about tariffs and some of the trade updates that we have going on. So I'd like to start by introducing our team of panelists and experts today. So my name is Stacy Craig. I serve in the tax department as a partner here at Saltmarsh, Cleveland and Gunn. With me is my colleague Christine Torrefranca. She is a senior manager and leader in our audit and attest services department. She has over 15 years of experience in industries such as manufacturing, distribution, and construction. In addition, today, we're welcoming one of our BDO Alliance friends and partners, Damon Pike. Damon is a principal at BDO USA, and he has over 37 years of experience in the highly technical field of international trade and customs regulatory compliance. Thank you, Damon, for taking this time to be able to discuss your experiences with us. And last but certainly not least, we have Troy Underwood. So Troy is the owner of Urban Metals LLC, and it does its name under Tampa Steel and Supply. Troy has extensive record in management and sales of consumer and industrial building products. Prior to his position at Tampa Steel and Supply, Troy oversaw the stone veneer manufacturing facility and environmental stoneworks in Atlanta, where he learned and implemented lean manufacturing principles. In addition to being on the board of directors for the Bay Area Manufacturers Association as board chair, Troy volunteers as an advisor to both Hillsborough Community College, Office of Administrative Program and Welding Program. Troy is a veteran, having served honorably for 9 years as an officer in the Army Reserve. His company is certified by the state of Florida's Office of Supplier Diversity as a veteran-owned business. Troy, we are so glad that you're here with us today and able to join in this discussion through a manufacturer's lens. So we wanted to start off today just talking about tariffs. It's been in the news a lot, and from a very 35,000-foot view, we know that tariffs are a form of taxes that are imposed by the government on imported goods. But there's still a lot of confusion, a lot of questions out there. How did we get here? What exactly are these tariffs based off of? What is a custom code? Are there a chance to get refunds when you pay in these types of custom duties and fees? There's some common misconceptions out there about who pays the fees on the tariffs or who's impacted by the tariffs. What's going on today with the tariffs? Is there going to be any leveling off? Are these permanent, or is this Congress makes that decision? Does the president make that decision? There's a whole host of things kind of swirling out there, and we just wanted to bring together this group to be able to talk about a little bit of the background of the tariffs. In addition, we've really heard from our manufacturers that a lot of you feel like, you're out on an island, you're not exactly sure what's happening, what's going on. We know that manufacturers in general are being impacted by tariffs through increased production costs, supply chain disruptions, investment hesitation. The global competitiveness has been impacted for many of our manufacturers, and there's a wide variety of responses as well. And so some of these are very, knee-jerk reactions. Some of them are more strategic reactions, such as passing on cost to customers, renegotiating with their suppliers. There's a large focus on inventory management than what we've seen in the past. In addition, there has been some automation investment to try to reduce the reliance on imports, as well as tariff engineering to reclassify goods or to move production to lower tariff regions, as well as reshoring to bring that manufacturing back onto our shores for high value goods with advanced processes. So we wanted to take a look today to see what's going on with tariffs, and then how are we seeing locally a manufacturer respond to these different types of things. So first, I would like to pass this over to Damon Pike, our expert from BDO, who's been working extensively in this area, to tell us what is the background on tariffs? How do we determine what's new and what's old, and how do we move forward in this new age of tariffs?
Hello, everybody. It's a pleasure to be with you today. I'm a principal with BDO's Customs and International Trade Services Group, which I founded at the firm in 2019. Prior to that, I was actually a business resource network firm within the BDO Alliance program, and I had my own law firm. And prior to that, I worked for a Big Four firm heading up their customs and trade practice. So all told, I've been in this field since 1989, and I can't say I've ever seen a year like 2025 ever since I began in this field. It's been quite a roller coaster. So where to begin? There is a lot of stuff to talk about, but I think as Stacy mentioned earlier, customs duties are taxes, and that's probably where I should start because I spent a lot of time when I was growing up in Germany, which of course has a big VAT, value added tax. Every other country outside the United States has VAT, and they also have excise taxes and customs duties as well. So those are known collectively as indirect taxes as opposed to income taxes, which are direct taxes, corporate taxes. So outside the United States, there's always been somebody that's been responsible for customs duties in a corporate tax department. Not so in the United States. Finding out who is actually in charge of customs compliance and customs planning with any organization is like a crapshoot. We can be housed anywhere in logistics, in procurement, in legal, in tax, sometimes other organizational structures, compliance overall. Sometimes we have chief compliance officers now. But the point is that with customs duties now at an average rate of 21% in 2025, U.S. companies now, many of them are going to be paying more money in customs duties than they do in corporate income taxes. So it would behoove everybody in the tax world to wake up, pay attention, and maybe take ownership because there's going to be a lot of money flowing back and forth in and out of the Treasury. And we hope as a result of this presentation, you might be able to get some duty refunds and cash savings locked in going forward. So just at a high level, in the Constitution, Article 1, Section 8, it does give Congress and only Congress the exclusive authority to regulate trade with foreign nations and to impose taxes, duties, and excises. It's in the Constitution. So from the founding of the Republic in 1789 all the way up through the early 20th century, it wasn't that hard to manage. The economy back then was not nearly as complicated or advanced as it was today, and we certainly didn't have a real global economy. So Congress took care of all that until the early part of the 20th century when Congress delegated some of its authority over duties and tariffs to what was then called the U.S. Trade Commission. And that was established to actually set duty rates and manage duty rates. It's now called the U.S. International Trade Commission. I think that was around 1911 when Woodrow Wilson was president. And by the way, I'm also a law professor at Emory University, so I do kind of like to put on my law professor hat here and talk a little history before we dive into the current conundrum. Then in 1913, we got the income tax, right? And so all of a sudden, customs duties started getting eclipsed by income taxes until we had something that happened in October of 1929, the crash. And all of a sudden, all of those corporate income taxes that companies were paying dried up because nobody was making any money. And we got into a Great Depression. And to replace the lost revenue from income taxes, what did Congress do? They passed the Smoot-Hawley Tariff Act of 1930, which raised tariffs back up to where they've been in the previous century, much higher, sometimes up to a 60% duty rate, which only further worsened the Great Depression, many people think was a cause of World War II, and we know how that turned out. Not such a great ending. So as a result of that mess, all of the victors got together in World War II and created the General Agreement on Tariffs and Trade because they wanted to have a global framework so countries could manage their trade duties and their relations and set tariffs kind of uniformly, like everybody was on the same page. So that worked pretty well from 1947 until 1995. That was really the golden era of free trade. Everybody was trying to bring tariffs down, and it did have very marked, tangible results. World trade exploded, and in view of many people, lifted a lot of people out of poverty and created jobs and all that good stuff, which trade is supposed to do. In 1995, the World Trade Organization was born out of the GATT because the GATT only covered trade in merchandise. The WTO covered trade and services for the first time, government procurement, arbitration proceedings, or all kinds of other things that were not included in the GATT. But one of the things that happened after 1995 was China got admitted in 2001. And a lot of people did not want that to happen because China was not a market economy. They were known to engage in currency manipulation. In doing business with China, a lot of people found their intellectual property was stolen. So, nonetheless, we went ahead and admitted China. And then throughout the early part of the 21st century, a lot of American companies, a lot of European companies, Western companies were getting very rich doing business in China under the auspices of the World Trade Organization, notwithstanding the fact that China still wasn't, exactly playing by the rules. So along came President Trump during his first term, and for the first time, he started using some of what are called the trade remedy statutes that Congress had enacted to delegate, again, it's delegation of authority from the Constitution to the executive branch away from Congress to impose certain kinds of tariffs. So the different kinds of trade remedy tariffs that he chose to use in his first term were the Section 301 China tariffs. That's where, under Section 301 of the Trade Act of 1974, the president, through an investigation by the appropriate agency, in this case it was the Office of the U.S. Trade Representative, they investigated whether China's acts, policies, and practices unfairly burdened U.S. commerce, discriminated against U.S. commerce, et cetera. And of course, the result was yes. The final report of the Commerce Department said yes. And Mr. President, we recommend that you impose these tariffs of, it was originally 10% and then went up to 15 and then later 25% on lists of merchandise. So these lists, as you may remember, were list 1, 2, 3, and 4. And those lists were all comprised of tariff codes. Tariff codes are very important for what's happening in the world today with tariffs because all of these trade remedy tariffs that are being imposed, except for IEEPA, the International Emergency Economic Powers Act, which is not a trade remedy statute. I'll get to that in a minute. But all of the trade remedy statutes, these tariffs are imposed based on the individual tariff code. So the tariff codes are based on the Harmonized Commodity Description and Coding System. It's written by the World Customs Organization in Brussels. It's completely, and there's 192 member states, so all of the major trading nations get together. It's like the United Nations for customs. They get together and they have a harmonized system committee, and they write the tariff descriptions. There's about 5,900 tariff descriptions at the what we call subheading level, which is 6 digits, and then at the 8 and 10-digit level. And by the way, the 2-digit level is called the chapter. The 4-digit level is called the heading. I just mentioned the subheading. The 8-digit tariff item level, and then the 10-digit international statistical suffix. So those numbers determine the tariff code. And the United States tariff schedule, which by the way is a statute passed by Congress, there are 17,000 different descriptions of merchandise. And you, as the importer of record, have the lovely task of matching up the exact product that you want to import to one of those 17,000 descriptions. Not an easy task, and never is it always black and white, almost never. So there's a lot of subjectivity that goes into that. A lot of foreign companies will put, let's say, they're sending products from China, and they don't want you, their U.S. customer, to pay the 25% China tariff. They'll go back to one of those lists and look for a tariff code that's not on the list, and then they'll put that on the invoice and say, here's the tariff code you should use. And hopefully the importers of record know better because they know that they're the ones that are legally liable, not the Chinese producer who falsely put the wrong tariff code on the invoice intentionally to avoid the payment of duties. That's called fraud. And so you have to be really on your toes when you're looking at tariff codes. That's the whole name of the game in this new world that we're living in. So that was the first statute that President Trump used. And then he used another one called Section 232 of the Trade Expansion Act of 1962, another trade remedy statute which had never really been used before extensively by any president. But he chose to investigate products that were threatening the U.S. national security. And of course, that was the Commerce Department. They found, not surprisingly, that imports of aluminum and steel raw materials were injuring and threatening U.S. national security. Those tariffs were imposed in 2018, as well as the Section 301 China tariffs. Those originally applied only to the raw materials themselves. And then there was also an exclusion process where a lot of US companies that couldn't purchase domestically, in other words, the product wasn't made here, they had to import. So they were able to get out of those Section 232 duties on steel and aluminum, which applied to imports from most all countries. Some got out of them originally, and then a lot of the other countries got out through side deals. And so those tariffs are still in place. However, with a twist, and by the way, the Section 301 China tariffs are also still in place. The Section 232 duties now are encompass not only steel and aluminum raw materials, but also downstream and derivative products. And copper was added the other week. And the duty rate originally went from 10% aluminum to 25%. Now it's at 50%. Steel went from 25 to 50%, and copper started at 50%. So now there's an additional 50% duty on anything that's imported into the United States made of steel, copper, and aluminum. Pretty significant financial hit because customs duties are cash, they're above the line, they have to be paid every time a ship docks, a container's unloaded. That money has to be, that cash has to be deposited with US Customs. So after the Section 232 duties, the other statute that President Trump utilized, which had never, ever been utilized by any president to impose tariffs, was IEEPA, the International Emergency Economic Powers Act. This statute was passed in 1977. It was a successor statute to the Trading with the Enemy Act of 1917, which the U.S. passed during wartime, during World War I, to allow the president to declare national emergencies in times of war and then go after those enemy nations with things like sanctions. They froze bank accounts and things like that. The IEEPA was passed to allow the president to do that in peacetime as well as wartime. And the first president to use IEEPA was Jimmy Carter. In 1979, we had a little problem in Iran. Remember, our embassy diplomats were all held hostage by the Iranian revolutionaries. So President Carter declared a national emergency. And as a result of that national emergency, the Shah of Iran's assets were seized. And apparently we're still fighting over those assets because that national emergency is still in effect since 1979. Those national emergencies can be canceled, however, or canceled, I guess, by Congress. It takes a joint resolution by both the House and the Senate by a simple majority vote to overturn whatever national emergency the president declares. But just like any other piece of legislation, the president can veto the joint resolution, which then would require it to be overridden by the standard 2/3 vote, which probably would not happen. So that's the background of IEEPA, but in the statute itself, it allows the president to do certain things. There are certain areas that statute talks about, one of which is to regulate imports and exports, but it doesn't say that the president is allowed to impose tariffs. So when President Trump came into office, he said the first thing he was going to do was slap tariffs under that statute on imports from China, Canada, and Mexico because of the flow of illegal fentanyl and precursor chemicals, as well as illegal migrants. So those were referred to colloquially as the fentanyl tariffs, which came into place on February 1st for China, and then later it was raised, and then Canada and Mexico also, it was imposed on March 4th. So those IEEPA tariffs have been in place for that reason, for that national emergency. That was the first one. The second national emergency was what was referred to as Liberation Day, when the new IEEPA reciprocal and universal tariffs were announced, because the national emergency was that, are you ready? Drum roll. We have trade deficits, persistent trade deficits with a lot of countries. Whether that's a national emergency or not, I don't know, nor is fentanyl. I don't know how tariffs are a measure to counteract the national emergency of illegal fentanyl and precursor chemicals and illegal migrants. And in fact, those two sets of tariffs were already declared illegal by two federal courts, the U.S. Court of International Trade in New York, where I used to work, and then the U.S. Court of Appeals for the District of Columbia. Both of those cases are now on appeal. The oral argument is scheduled in the Federal Circuit case next Thursday, and it will be by the entire panel of judges. That's called en banc in the legal term. And then the District of Columbia Court of Appeals will also hear that case from the district court. And then you know where it's headed, right? The big nine. It's all going up to the Supreme Court. So hopefully that will get a decision on that this year. But back to Liberation Day. So those tariffs were announced in two waves. The 10% universal tariff was imposed on products from almost all countries. There was some exception for oil and gas, commodity products, and things like that. But and then in addition to the 10% universal tariff, there were 57 different country-specific tariffs that were imposed based on this idea of trade deficits. Those tariffs were, in most cases, much higher than 10%, the universal baseline tariffs. For instance, the European Union was targeted with 20% imports from the European Union were targeted with a 20% tariff. Japan was at 24, and some of our other major trading nations were also up there. There was such a strong outcry to those tariffs, they were paused for 90 days until July 9th. That pause was further extended until August 1st. In the meantime, the idea was that all of these countries that had 57 different specific rates would be able to come to the negotiating table and reach deals with the United States. The problem is that, well, number one, we don't have trade promotion authority anymore in this country. That is a statute whereby Congress delegates its authority to negotiate free trade agreements and come up with new duty rates for these countries that are covered by the agreements. And then once that agreement is finalized, it gets submitted to Congress for an up or down vote with no amendments, because we can't have 535 members of Congress attaching their own pork bill spending on each free trade agreement. So that was back in the days when we had real free trade agreements. As you remember, when Trump was in office, he replaced NAFTA with USMCA. That was a real trade agreement done under Trade Promotion Authority. Congress was consulted on the way, and then the bill was finally agreed to. It was submitted to Congress, and it passed. We don't have that anymore. Trade Promotion Authority expired in 2021 when Biden was president, and so now these deals that are being put together are really just deals. They're not a free trade agreement. They have they're not voted on by Congress. They don't have any permanence. Any country, presumably for any reason, can withdraw from any of these deals at any time, even during this administration, without even considering what the next administration might do. So that's the first problem. They're not really binding, and they're certainly not statutes. And then secondly, the office that typically negotiates these trade agreements, the Office of the U.S. Trade Representative, is one of the smallest agencies in the federal government. It only has like 300 employees. So to think that we could negotiate a complete trade deal with a major trading bloc like the European Union on this short timetable, it's kind of stretching resources where we don't have any to begin with. There just isn't enough time. There's no bandwidth for the U.S. government to engage in these massive negotiations and come up with any real lasting results. So a lot of people are hoping that when Congress comes back and after the August recess and decides and sees what's happening with tariffs, maybe they'll start to reassert their authority. And I think I just read something about a bill being passed to exempt small businesses that are exporting to Canada and Mexico from the retaliatory tariffs, and also from the U.S. tariff. So a lot going on there. I think the news that you've probably heard recently concerns the deals. But let me just share my screen here for a minute. I've got a deck here that kind of summarizes all the tariffs that I've talked about. I'm not going to go through these, and some of these also are already, I think I put this together last week, it's already out of date. So we've got a lot of things going on with IEEPA, but the one thing that you should, and you can read these here, I'm not going to go back through all of these, but the one important thing to remember when I mentioned duty refunds is that importers in the United States pay the duties, not the foreign governments. So when the importers, which can also be non-resident importers of records, so foreign companies that have registered in the United States to sign up and pay the duties, like Canada, there's a ton of non-resident Canadian importers in the United States. All of these tariffs that have been paid on under IEEPA may be eligible for refunds if, like I said, the Supreme Court finally takes the case and maybe decides that probably the president doesn't have authority to impose tariffs under IEEPA. Both of the lower courts said that the Congress did not give the president unbounded authority to impose tariffs, and the statute was not even really crafted to focus on tariffs to begin with. It's really the heart of our sanctions regime. So when you look at export controls and sanctions on bad actors, transnational criminal gangs, it's IEEPA that's the heart of all of these sanctions. It's never been used before to impose tariffs. But if the court eventually invalidates the IEEPA tariffs, importers are going to be entitled to a bunch of money. There's about $55 billion that has been paid just so far this year in these IEEPA tariffs. And in order to claim a refund, importers have to be able to track the tariffs exactly by shipment, by tariff code number, by date. So, as I tell people in my income tax world, filing a tax return once a year with one number on it is the sandbox. But if you're an importer of merchandise, all of those grains of sand are the transactions that we have to actually deal with. So when you're looking at, we do a lot of work in the automotive space. An OEM company can file one corporate tax return, and that OEM can file 600, 700, 800,000 entries with U.S. Customs. That's like the transactional tax return, as we call it. Every one of those entries has to be managed and has to be examined to determine whether or not duties are eligible for refunds. So the way to get those refunds is you first have to sign up for an ACE account. It's called the Automated Commercial Environment. This is the mainframe system that's operated by U.S. Customs and Border Protection. It's been operational for 7 or 8 years now. There are 49 federal government agencies that touch an import or export transaction. Eventually, every one of those agencies is going to have to be integrated into ACE. So that's why it's also called the single window. There's about 15 agencies now that are in there, but it's really a customs operated system. You can get an ACE portal account for free. Just sign up online. Once you have your ACE portal account, you've got to get a designated account owner, somebody who can go on at least once a month and take a look at the data of what's being reported to customs. And it's important because that data is where the money is. If you don't have access to that data, and again, this is the same data that the government has. So you're not having to go back and recreate stuff by getting, Excel spreadsheets from your customs broker and whatever. It's all in ACE, all available for free. And then you've got to make sure you go back and look at your chart of accounts, because to this day, it still surprises me that some smaller companies don't even break out the cost of customs duties from freight and transportation. It's all buried in there, and so they have no visibility to anything. So now with the different kinds of tariffs, you've got to actually have in your chart of accounts more than one kind of tariff. You can't just say tariffs or duties. It's the same thing. It used to be we only had what are called normal trade relations duties. So I use the abbreviation NTR. I'm old. I actually go back to the most favored nation status, the tariffs that we used to call them MFN. But you need, in your chart of accounts, you need to have NTR duties, you need to have Section 301 duties, you need to have Section 232 duties, you need to have IEEPA duties, and then if you've got anti-dumping or countervailing duties, that needs to be a separate account in your chart of accounts. And then we have merchandise processing fees and harbor maintenance fees. So I've just given you a whole bunch of work for your accounting team to get busy and set up these charts properly to track all of these new tariffs. Because no matter what happens, these tariffs, I think, are going to be around for a while. And the impending deadline for the IEEPA refunds is going to be about November. So under the rules, when you import merchandise for the first 314 days about from the date of entry, Customs has time to look at what's being reported. And during the time period when that review is taking place, those entries are considered unliquidated. They're open. After about 314 days, Customs closes out those entries on a Friday. It's only on a Friday. That's why it's only about 314 days. It's whatever Friday is closest to the 314-day deadline. And then when Customs finally assesses the duties and closes it out, that's called liquidation. So once an entry has been liquidated, then you have you have 180 days or 6 months to file a refund claim. So if you think back, the IEEPA tariff started on February 1st, others were added in April, and you count forward 314 days, that's your deadline for starting the protest filings. And then you have 6 months to capture everything. But if you miss the filing deadline by 1 day after that 6-month period elapses, you're out of luck. You can't get the duties back. So very, very important to keep track of all that stuff. Let me move down here to the next slide. These are the Section 232 and Section 301 tariffs that I mentioned, as well as some of the items that are under investigation. With all of these duties, it's also important to remember, and again, this is why you need them broken out in your chart of accounts separately, they are, in most cases, cumulative. They're all stackable. So you pay Section 232 duties, Section 301 duties. You might have some Section 201 safeguard tariffs. That's another one I didn't mention. That's when you have import surges that really harm U.S. industries. There's an investigation by the U.S. International Trade Commission. So that's called Section 201 tariffs. We currently have them on solar panels and cells. But all of these duties need to be kept track of separately. But the Section 232 duties are the ones that are still out there as a ticking time bomb, I'll call it, because these products that are under review now cover a lot of stuff: commercial aircraft and jet engines, trucks, semiconductors, or anything with a semiconductor in it, semiconductor manufacturing equipment, pharmaceuticals. You might have seen the other day that President Trump threatened 200% duties on pharmaceutical products, but he was going to give everyone a year to kind of get used to that and hopefully move manufacturing back to the United States. So those are still out there. And then another big one is critical minerals, rare earth metals and derivatives, because those are very, very important items right now. China controls the world supply of a lot of these critical minerals that are needed to operate, for instance, U.S. weapon systems, electrical grids, all kinds of critical infrastructure. And so critical minerals is another big area of focus that's going to come up pretty shortly. All of these Section 232 investigations, again, they're done by well, in this case, they're done by the Commerce Department. They operate on statutory deadlines. They have to be completed within 270 days of the date that the president initiates the investigation. Most people, including me, think we're going to get the decisions a lot quicker. The copper investigation started in February, and that was just concluded last week. So, or it was concluded. It started on March 1st, and we got a decision within 5 months. So look for more. The bottom line is look for more Section 232 national security tariffs. They're going to be coming up pretty quickly here, and they could be, like I said, as high as 200% on top of these other duties that are stackable. There's some exceptions for the auto parts tariffs versus the steel tariff, steel and aluminum. So it's either or, you don't pay both. But in general, all of these duties are stackable. And of course, not everybody is happy about this, and we have a lot of our foreign trading partners busy retaliating. Canada is really not happy. They were the first country to substantially impose retaliatory tariffs against the United States that went into in effect on March 4th. We've had more since then. They've targeted a whole host of American products, again, all done by harmonized tariff code. I've heard, and then the current rate of 25% that applies on goods from Canada that are coming in that are not duty-free under the USMCA free trade agreement, that rate has now been proposed to go up to 35%. And I just saw yesterday that the Prime Minister up there, Carney, apparently does not want to do any further negotiation with Trump. So looking at 35% tariffs now on non-USMCA Canadian goods starting next Friday, August 1st. The EU just passed yesterday a whole new list of countermeasures that include not only duties, but other things like import bans on U.S. steel that's going to go into effect on August 1st if we don't have a deal with the EU. I saw that the EU president is over in Scotland about to see Trump at his golf course to talk. Ursula von der Leyen is going to speak with him tomorrow about what might happen with respect to the EU. That's obviously a hugely important trading relationship. And it's also ironic that the America First trade policy that Trump announced on January 20th to bring manufacturing back to the United States is going to require companies to buy a lot of really expensive machinery, sophisticated, expensive machinery to produce goods that are made in factories. Well, where do you think a lot of that equipment comes from? European Union, Germany, Austria, they have really expensive equipment that is good at producing lots of stuff. But if you have to pay a 30% tariff on $1 million machine and add $300,000 to your landed cost, is that really going to incentivize manufacturing to move back to the United States? I don't know. It's an open question. And then, of course, there's other countries. Brazil, that was in the news recently. They've already announced that they're going to retaliate with a 50% tariff if Trump follows through with his promise of imposing tariffs of 50% on Brazilian goods. He originally stated he was doing it because he didn't like what happened to his buddy, the former president of Brazil, who's on trial for overturning the results of their election. But then a couple days later, the United States announced a new Section 301 investigation. That's the one like we have on the China tariffs Brazil's acts, policies, and practices that unfairly burden U.S. commerce. So that's how that works. We have a lot of other stuff going on. I think there's so much where I'm going to just pause right here and stop because I've used up a lot of your time, and I want to thank you all for attending. We do have one comprehensive article that I wrote that just came out on BDO.com. It's a look forward and a look back at all of the Trump tariffs. So everything you need to know in narrative form since January 1st is all on BDO.com. And I would encourage everybody to read it and hang in there. We'll see what happens.
Thank you so much, Damon. This was so much valuable information. And my takeaway here for our accounting folks is you're going to be pretty busy, and get that ACE account set up.
Right, right. And use it. Don't just set it up, use it. It's a really great tool for compliance. And brokers make errors all the time. You would be surprised how many clerical errors you can spot and get duty refunds just because the ACE data wasn't correct.
Great, great. Thank you so much for your time today. We greatly appreciate it, and we look forward to reading that article.
Thank you.
And for all of this insight, I think this has been very helpful. I know a lot of accounting departments are going to be very busy over the next few weeks and months. And, you know, one of our other areas that we really want to talk about today is how are these tariffs impacting our local manufacturers. So I'm going to pass it over to Christine now, who is going to have a discussion with Troy about what he's seen in his practice. Christine?
Thank you so much, Stacy. Troy Underwood is, of course, an owner of Urban Metals here in Tampa, Florida. And Troy, I would like to know the impact on the 2019 tariffs on steel, and can you give our viewers some background on that tariff and how it impacted your business?
Certainly. The 2019 steel and aluminum tariffs were really part of a broader trade policy aimed at protecting U.S. metal producers. And it seemed like practically overnight, the cost of key materials jumped. Steel prices became unpredictable, and in some cases were like significantly higher. And this squeezed our margins and forced us to make some really tough decisions. First, we had to quickly find new suppliers, both domestic and international, who could offer us more competitive pricing and reliable lead times because a lot of our material was coming from offshore. And so this added a layer of complexity to our operations, but it also pushed us to be a little bit more agile in our sourcing strategy and also more transparent with our customers about cost fluctuations. So we really had to engage with them that our prices, we weren't just deciding that we needed to raise prices, that there was some action behind it. And it was a challenging period, but it ultimately made us more resilient, especially after we got through this tariff thing. COVID hit, and that created a whole supply chain scenario that we were more able to deal with because of what we had gone through in the 2019 tariff situation.
How has the current tariff today changed compared to previous rounds? And how did your experience during the 2019 help you adapt to these changes today?
Well, this round of tariffs is, I think, a little bit more targeted and strategic compared to 2019. It's kind of all over the place, as Damon was talking about, but it still brings uncertainty and potential cost increases. The biggest difference now is that we've been through this before. We know the playbook. The 2019 tariffs taught us how to respond quickly, to diversify our supplier base, lock in pricing where we could, and build inventory while maintaining cash, and communicate early with our customers about the impacts. And that experience built a level of, I would say, agility in our business that we are leaning on again. While disruptions are really never easy, we're better prepared to adapt and manage risk and protect our operations and our customers, we think, from the worst volatility. On top of that, we're also seeing domestic producers raise their costs to cover capital investments aimed at increasing their manufacturing capacity. And that has added another layer to the pricing pressure that we're seeing in the equation.
Are you absorbing some of that additional cost, or you're passing them to your customers, or a mix of both?
Well, the benefit for us is we're not project based. A lot of ours is walk-in, so we're able to adapt our pricing a little bit quicker and better. And so we are passing on whatever cost we have and not really eating anything. Our eating is really managing our cash flow and making sure that we have enough to have the right material and trying to make the right buys ahead of time, that we can hold some of that pricing, that maybe if it does go up in the future, we have enough inventory that we can hold our price for our customer.
Fantastic. What other long-term strategic plans that you have that could help other manufacturers mitigate the impact of tariffs?
Well, long term, our strategy is to mitigate the impact of the tariff, and it centers on really diversification and stronger supplier partnerships. We're continually expanding and diversifying our supplier network, both domestically and internationally, to reduce the dependency on one source or one region. And more importantly, we're trying to build long-term relationships with trusted suppliers. And that allows us to negotiate more stable pricing and stay ahead of potential disruptions. And while we do everything we can to plan ahead, we recognize, like planning a perfect picnic, you really can't predict the weather. So that's why we focus on flexibility and responsiveness, so that we're ready to adapt quickly when those conditions change. So it's really about being flexible.
Fantastic. How about the issue of cash flows and also inventory management? Can you talk a little bit about that?
Yeah, managing cash flow alongside inventory, it's a careful balancing act, especially in a volatile pricing environment. We're more strategic than ever about what we stock. We really focus on the high demand, high turn items while trying to avoid overcommitting on some of the slower moving products. And we work closely with our suppliers to negotiate favorable terms where we can and adjust order quantities based on real-time demand. On the cash flow side, we've tightened our forecasting, and we really worked on improving our collections and prioritizing our investments that directly support our revenue generating activity. We're also fortunate, as I mentioned earlier, that we don't do a lot of project-based works, which gives us flexibility to adjust pricing on the spot without being locked into long-term contracts. That said, if we were to be involved in some long-term projects that were large, we'd absolutely include escalation clauses that are tied to the market or industry increases to protect ourselves and ensure that pricing remains, fair and sustainable for our customer.
Fantastic. We also are hearing that from our other clients as well. And last question, are you optimistic or concerned about the future of the trade policy affecting our industry?
Well, I try to stay optimistic about everything, and it's just something that we have to adapt to and overcome. And that's where I think that flexibility is critically important. I mean, I'm seeing the benefits of bringing manufacturing stateside, but obviously that's coming with a cost, because we really got to ramp up for it. So I think we still have to have a fine balancing act of what we import, but it's one of those things that I think that you stay optimistic, you're going to adapt to it better. And if you get caught into the negativity about it and have the Eeyore woe is me, it's going to be something that you never get out of. But if you can use it to improve your business and be more adaptable, it's going to help when other situations come up. Like for us, as I mentioned in 2019, if we hadn't had the tariffs, we probably wouldn't have been able to deal with COVID as well as we did to get through that. So you never know what may be next around the corner. So use it as an opportunity to improve your organization, improve your processes. Other situations come up. Like for us, as I mentioned in 2019, if we hadn't had the tariffs, we probably wouldn't have been able to deal with COVID as well as we did to get through that. So you never know what may be next around the corner. So use it as an opportunity to improve your organization, improve your processes.
Yes, thank you, Troy. That was a lot of insight there and a lot of helpful tips to stay adaptable, stay flexible, diversify. All great tips for our viewers here today. And so again, we would just like to thank Troy and Damon for joining Christine and I today. And we want to hear from you guys. What are you guys doing? What questions do you have? What future webinars would you like to see from us? So any of that information, please reach out, let us know. You can email us at marketing@saltmarshadvisors.com. We look forward to hearing from you, and we look forward to seeing you again soon. Thank you so much.